We're here for another installment of the In Conversation With series, trying to give some insights and information to clients and other interested parties using our internal experts. And so tonight we have Andrea, who's going to be talking about the budget, which is not full of tons of surprises, but we've all been eagerly anticipating what was going to be announced for weeks and months since the new Labor government came into power. It would be great if we could answer everybody's individual questions. What does this mean for me? We can't really do that in a setting like this, but hopefully we can get some basic insights into what it may mean, what to think about, and try and just cover where there were some surprises, positive and negative. So Andrea, welcome to the conversation.
Thank you, George. It's nice to be here today.
Luckily, you have to do all the heavy lifting. I just get to ask some probing questions. But let me just start with the big picture. When you listen to the budget, all of us probably were glued to TVs or something watching the budget. Overall, what was your impression as everything came out? What was your general sort of sense of hearing this budget?
I think from an overall perspective, actually, with all of the speculation and all of the lead up to kind of the actual announcements, I wasn't really all that surprised in terms of what was actually announced. In fact, I think in some respects, people, you probably anticipated a bit more extreme announcements than what actually were. And so maybe that, speculation in that direction actually helped make it seem like it wasn't as bad as it probably could have been.
Might have been,
but it still was very momentous, for sure.
Definitely. And I think I've heard that from a number of people, that in general, it's not underwhelming, but there was fear that it could be more dramatic. Maybe that's good politicking to sort of set the bar and then come in differently. And certainly the market reaction suggested that there wasn't a lot of sort of shock and awe there. For our clients, there were sort of different components that might have been important. Maybe we can just, without getting into the details yet, just sort of highlight what were some of the topical categories that were mentioned, and we can go into more detail.
Yeah, I think they kind of fell into a few different categories. There were changes that were announced in and around capital gains taxes, changes that were going to impact businesses in general, changes that were going to impact inheritance tax. And then kind of the big expected one was the changes that are going to be taking place with the non-domiciled tax regime as we currently know it.
Yeah, that non-dom thing has been kicking around for quite a long time. Sort of back in the spring, the then conservative government was making comments publicly. The Labor government in waiting was making comments. So that's been in play for quite a long time. And then we were hearing noises over the summer and since then about pensions and capital gains. So a lot of these topics seem like they have been floating around for a while. Is it your impression that having had these announcements that we now know what the future looks like, or are there still areas that there are open questions, again, without going into details yet, but just, is it all clear now, or are there still some areas that there's more to hear?
I think there is probably enough certainty to be able to kind of move forward with. I think there's still, with the non-domicile changes, 103 pages of draft legislation was actually
You've had a busy time.
Published alongside the budget and a technical note. So, I think there's plenty of detail there to kind of sift through. And so where there might be some small kind of open questions about how something will be handled, I do think the detail is kind of there. It's just everybody digesting it and looking at taking it forward as opposed to kind of new information needing to come out. And then there were a few areas where the government basically has said there'll be further consultation on next year and the year after. But also in areas that aren't unexpected, for instance, with carried interest rules.
Yeah, that's quite technical. That's not surprising. That's going to take a while to sort of really flesh out. Well, the last thing I wanted to have you comment on before we start to go into the details a little bit systematically is, I think one of the things that most clients will be thinking about at this stage is there something I should have done, right? Because there had been so many things floating around, and now this has happened. Is there some sense of, wow, if you did this or if you missed the chance to do this, oh well, or too bad or whatever. I don't have a sense that there's a lot of, you really should have done this if we had had perfect foresight, but maybe we can put that to rest for some people.
Yeah, I mean, I think there's always the benefit of hindsight, right? Once you
Exactly.
know the actual rules,
Yeah.
could you have done something different? And I guess, slightly different in this instance, maybe to prior budgets, is that there were a few announcements that were effective as of yesterday. Obviously capital gains tax rates went up. Did they go up as much as some people thought they were going to? No, I don't think they did. But in reality, if you, realized a capital gain 2 days ago versus today, it's going to cost you more today than it would have 2 days ago. And I guess outside of that, probably the only other thing that I would say, people could have used the benefit of hindsight is, people with existing trust structures. There is slightly different rules that are going to apply for settlements that happened prior to the 30th of October 2024 versus any new settlements that happen hereafter.
Right.
So I think those are probably the two areas that potentially,
Yeah.
there
It's
could
like,
have been.
ooh, if only.
Yeah.
Right.
Yeah.
I don't know if we'll have time to get to the trust question. That's one that probably affects fewer people and is somewhat technical. But let's start with capital gains and let's maybe start to delve more deeply into that. Can you just, for people that aren't following this as closely as we are, can you just first just detail what changed, what it was and what's happened, especially because that's gone into effect immediately?
Yeah. So the capital gains tax on any assets outside of real estate basically have increased from a basic rate tax of 10% up to 18%. And then the higher and additional rate tax of 20% has increased to 24%. So now the capital gains tax rates associated with, say, the sale of shares or mutual funds is actually going to be aligned with the capital gains tax rate that was in place for sale of residential property that maybe were second homes and of that nature. So now that will be aligned at 18% and 24%, depending on what tax band you sit in.
So in some sense, it's almost a simplification, sort of aligning the rates and so forth. It clearly it's gone up. Is it a surprise that the base rate change is higher than the higher rate change? Was that a surprise?
I mean, a little bit from the standpoint that, obviously on lower income kind of people that fall into that band, that percentage increase is a higher burden, but equally, again, that's how it was working for residential property as well. So I'm not sure it was a huge surprise. But.
And just for clarity, again, because not everyone's following this in the same amount of detail, I know there were elements of the budget that had sort of minimum asset values attached, whether this would apply or that would apply or so forth. Maybe we can just be clear in what situation these rates apply. Is it above or below certain thresholds or certain types of assets? Just maybe help make sure people aren't confused by what the changes do and don't change.
Yeah, I think with respect to capital gains, it's specific to capital assets other than real estate, and it's gains that are realized in excess of the capital gains tax allowance, which is currently £3,000 and will continue to be £3,000 going forward. There are some different rates associated with things like business asset disposal relief, which can be associated with business sales. And that was announced, a change to that was also announced with respect to the £1 million relief still staying in place, with the 10% rate on that £1 million. But from April of 2025, in the 25-26 tax year, that tax rate will increase from 10% to 14%. And from April 26, it will increase to 18%. So over the next 2 years, that business asset disposable rate relief, while the transition kind of amount of £1 million will still remain in place, the tax rate that's actually associated with that will increase as well.
So that's helpful, and that it's sort of a slow process to move up and align it. Interestingly, ends up aligning at that 18%. So almost simplifying a lot of these things, not changing the absolute quantum at $1 million, but sort of slowly changing the rate and aligning. So maybe at the end of this process, it might make some of these tax regimes easier for people to remember it and comprehend.
One would hope.
All of this is on the UK side, of course, because it's a UK budget. It may be worth just a quick reminder about the US capital gains tax, because part of the issue with clients that have US and UK exposure is the extent to which tax regimes in both places are different or aligned. So maybe just a quick reminder about the US side and how these things now look relative to each other.
Yeah, I think up until the change that was announced here in the UK, for the last couple of years, we've had the benefit of kind of capital gains tax rates largely aligning between the US and the UK. And that's helpful for kind of foreign tax credit purposes and just kind of having a look at unrealized gains and making decisions as to what might make sense to sell when. But now we have a position where essentially in the US, if you're under the top rate of tax from a marginal tax rate band standpoint, you will pay 15% on long-term capital gains. If you're in the top band in the US, you're going to pay 20% at capital gains tax rates. And then on the UK side, say you're generally paying 24% now on a go-forward basis. And so you do have a slightly higher tax now from a UK perspective than in the US. A lot of people in the US also are subject to something called the net investment income tax, or NIT, which is an extra 3.8% tax that gets assessed on passive sources of income. So many clients are paying tax at, say, 18.8% or 23.8%. And what this change means is actually many people's overall effective capital gains tax rate may now actually be going to 27.8%. So being the 24% tax assessed in the UK plus the 3.8% tax that is assessed on top of that from a US perspective. And that's mainly because that net investment income tax is not creditable against taxes paid in another jurisdiction. So that will always, if somebody is exposed to that, will always kind of sit on top of the top rate of tax that they're paying between the two jurisdictions.
Which is a continuation of where we've already been. So hopefully not unfamiliar to people in that situation.
Yeah.
Okay. That's all helpful. I think that makes the topic clear. Overall, not a ton of changes. The rates aren't changing dramatically, getting some equalization. Anything we're missing in making sure people understand what's happened with capital gains tax?
I don't think so. I think that covers.
Yeah. And frankly, I think for a lot of the advisors at the firm, that was one of the main things we were hearing was, should I be selling assets in advance and going up and so forth and so on. So that's one of the big ones that was on people's minds, clearly. Even though the UK and the US have had more alignment in general over time, we're going to have a new government in the US also. We don't yet know exactly what that's going to be composed of in terms of legislation that will or won't get passed or whatever, but there will be a new government in the US like we have had in the UK. I haven't heard any comments that there is a potential change in capital gains tax in the US. But before we leave the topic entirely, let me just ask, is that something that you've heard anything about? Is that something that clients have asked you about as our technical expert in this area?
I think it's, the topic has cropped up in some proposals and things like that in terms of what various candidates' tax plans may look like. But I don't think that there's any huge kind of imminent chance of that changing from a US standpoint, regardless of kind of the outcome of the US election. But that will, I guess, remain to be seen as we
Yes,
as we take
exactly.
things forward.
Exactly.
Yeah.
So away from capital gains, I think we've covered that pretty well. I think the other big topic that people have been talking about all year is the non-dom regime, because it was discussed so much earlier in the year. And a bit like the capital gains tax question, we had a lot of client queries saying, should I be doing something about this? Because there was so much noise about it previously. Let's just start with what has been announced in the budget that sort of confirms what the noise was before.
I mean, this is certainly, I think, one of those areas that I think everybody is very, very happy to have some level of certainty now, regardless of what the outcome actually
Just
was.
so you can plan,
because,
just so you know.
yeah, it carried on for so
Yeah.
long in terms of what the proposals were and kind of then the proposals changing. So I think it's just a good place to be. But largely, what we expected with respect to the original proposals are what's kind of coming out now, with respect to the changes. So the non-domicile tax regime, as we currently know it, will completely be abolished as of April 2025. The concept of domicile will actually just go away, and it will be replaced with a residency-based tax regime. And with that, essentially, the government has laid out kind of how that then will work, both for existing residents in the UK and for new residents that come and live in the UK.
Let's start with the existing, because I'm sure there will be people who are thinking of moving across. Most of our audience are already here. So what's the existing one?
For anybody who is an existing UK tax resident and has been tax resident for more than 4 UK tax years.
And just define tax resident, so we make sure that piece is clear.
Yeah, so anybody who meets something called the statutory residence test and is living here in the UK will be considered UK tax residents.
Perfect.
And if they have met that test for more than 4 tax years, then they will essentially lose the ability of paying tax on the remittance basis on a go-forward basis from April of 2025, and will pay tax on the arising basis from that point forward, meaning arising, you're paying tax on your worldwide income as it basically is earned as it happens, which, for our, American clients really isn't, so different for them, because they'll already be paying tax on their worldwide assets from a US perspective. And so this does now align kind of both jurisdictions at, for the same kind of income each year.
Under the prior rules, you sort of had a 7-year window instead of 4. And you had the same idea of remittance versus arising and so forth. It was a voluntary thing. So you could choose to be taxed on a remittance basis or choose to pay on an arising basis. Is it still that same voluntary regime? And is the only difference really that we're calling it something different? The non-dom name has disappeared and the years have shrunk from 7 to 4 for this piece.
You lose the ability to choose after the 4th tax year. So, for anybody who hasn't yet been in the UK for 4 tax years, you have an election that you could actually make to pay tax on the arising basis, or you could actually elect to exclude your foreign income and gains from being taxed in the 4 tax years.
Okay.
But once you're kind of past that point of being resident for 4 tax years, you no longer have the ability or option to elect something different. You will pay tax in the UK on your worldwide income every year thereafter, to the extent you remain in the UK.
Right. And just building on your earlier comment and not making specific recommendations because we don't have a particular person in front of us, but just understanding the regime, it sounds like it makes more sense probably for an American here, since they're already taxed globally anyway, and to get the alignment with the US and the UK, to be on an arising basis maybe more often than not. Is that what I'm hearing correctly?
Yeah, I think generally that ends up being the case for most people. There have historically been instances where, people might have assets in certain sort of structures or entities where it's taxed differently from a UK perspective than a US perspective. and having the ability to pay tax on the remittance basis allowed them to avoid having to kind of restructure things to make it tax efficient in both jurisdictions. So this change does kind of accelerate the need to think about the efficiency from kind of both jurisdictions versus just the US. And being able to kick the can down the road from a UK perspective. So that certainly has kind of accelerated some of that thinking for some people. But I think on the whole, specifically for the American non-domiciled individual here in the UK, having to pay tax on an arising basis in the UK alongside the US filings isn't really representing a big change for them.
Perfect. Okay, so we've talked about the existing people. Let's talk about those people leaving the UK, and then we'll come back around to talking to people coming to the UK as the third piece. So you're already here and leaving the UK. Given the change or abolition of the non-dom regime, what does it now mean to leave the UK given what's changed?
From an income tax standpoint, it doesn't actually mean very much. If you leave the UK and you are no longer a UK tax resident under the statutory residence test, then you won't have to pay tax on an arising basis in the UK any longer. I think the bigger change for people leaving the UK is actually around the inheritance tax side of the equation, where, currently now the new rules basically say that once you have been resident in the UK for 10 out of the last 20 years, you will be considered what's now going to be called long-term resident in the UK. And once you are long-term resident in the UK, you will be exposed to UK inheritance tax on worldwide assets. And so then the process of leaving the UK, once you are exposed to being a long-term resident, basically has a bit of a tail that will follow you when you leave the UK. And so you can continue to be exposed to inheritance tax on a go-forward basis for a period of time of up to 10 years.
That's, I think, very clear. Again, just for frame of reference, just say a word about what it was before yesterday in terms of how that new 10-year tail looks versus what it was just before.
Yeah. So,
actually, all this doesn't kick in until April, but...
Yeah. So under the current rules, basically, anybody who hasn't been UK tax resident for more than 15 out of the last 20 years would be able to leave the UK without having any kind of lingering exposure to the UK.
Yeah.
So now that's shortened to 10 out of the last 20 years. And equally under the current rules as well, if somebody was already UK tax resident for more than 15 out of 20 years, when they left the UK permanently, their exposure would continue for 4 years as opposed to potentially 10 years. So that tail has been extended as well, depending on how long somebody has been resident here.
So you get caught earlier and you're in that web longer. Mm-hmm. So not a dramatic change, but the years are shifted.
Yeah. Yeah.
If the third category is people that haven't yet moved here, what do the new announcements mean for those people? Since, this broadcast is very popular, it gets sent worldwide. I'm sure it'll be sent to tons of people in the U.S. who are thinking of coming here. What do the new rules mean for them?
Yeah, I mean, what's very, very interesting actually with the new rules is that people who are returning to the UK after a long period of non-residence actually will have an arguably much more favorable opportunity for the first 4 tax years that they become tax resident in the UK.
Hey, some good news. All right.
Yeah, it definitely can be. So basically, if you had not been UK tax resident for the last 10 years and you return to the UK for the first 4 tax years that you're here, you are allowed to elect to exempt foreign income and gains from being taxed in the UK at any point in time. And so actually you no longer have to kind of segregate income, and you can fully have the ability to remit income onshore to the UK without ever paying tax on any income that is earned during those first four tax years. And the most interesting part of that change is actually that it also applies to individuals who used to would have you've fallen under the kind of domicile of origin or formerly domiciled resident kind of rules in the UK, whereas previously, if they returned to the UK, they would be subject to tax on an arising basis from day one, whereas now they will have this period of 4 tax years where they can actually be exempt from foreign taxes and from a UK perspective, and that's something that wasn't available
That's
previously.
quite big. I mean, to put it in sort of lay terms, as a Brit going to the U.S., you could be there 20 years. The day you came back, you were fully back into that whole regime and the old non-dom rules. But what we're saying now is the new changes mean a Brit that's been away for a long time, when they come back, they get to act like the new non-dom that doesn't exist rules. That's quite a big change.
Yeah, exactly. And I think initially when the proposals came out, there were a lot of people that thought, surely, this isn't going to be the case. But the reality is, if you're shifting away from domicile and you're looking purely at residence, then you can't really, I guess, kind of isolate
differentiate
that
where
group
you
of people.
originally were coming from.
Yeah.
Right. And clearly, all of these are positive in terms of optionality for people, presumably meant to try and help bring more money into the country, is I guess why they're doing this. So when does that all kick in? Let's just make sure we know when this can take place.
Yeah, so that all starts from April of 2025. And so for anybody who actually is already here and maybe just recently became UK tax resident since 22-23 or later, or if they come to the UK for the first time, from April of 2025, they will be able to benefit from these new rules for the first 4 tax years that they're here. To the extent somebody's already here and maybe just became UK tax resident, it's allowed for the number of tax years until they reach that 5th tax year.
But if someone was thinking about moving here in February of next year and had the flexibility to actually move when they wanted to, is there a reason they should do it after April 6th as opposed to do it in February?
Yeah, I mean, I think to the extent they have the flexibility to determine when they actually become tax resident from a UK perspective, it would certainly be beneficial to kind of delay that to the 6th of April because it will offer them potentially another whole tax year to be able to avail themselves of these new rules.
So of course, I'm sure that would not be a primary reason that anyone would choose it or anything, but that's a helpful sort of application issue. Okay. What have we missed in talking about in terms of the changes in what used to be the non-dom regime and the new residency-based regime? Are there any other important elements we haven't gotten to?
Yeah, I think for existing kind of tax residents who now are finding themselves basically being pushed out of the remittance basis tax rules straight into the arising basis tax rules, there are some transitionary reliefs that the government have basically outlined to try to essentially help or smooth that transition through. So essentially, anybody who is not yet considered to be domiciled or deemed domiciled in the UK will have the opportunity to rebase existing foreign assets outside of the UK as of the market value of the 5th of April 2017, to the extent they still own those assets on the 6th of April 2025. So to the extent they're still holding those foreign assets, they can basically move the market value of or cost basis of those securities to be the market value on the 6th of April 2017. And then when they subsequently sell those securities in the future, they would just pay tax in the UK on the market value uplift from April of 2017 to the date of sale.
So that's a big deal. Let's just spend a minute on that, because the ability, you might have owned these assets for decades, and the ability to suddenly say, no, my cost basis isn't $5 a share, it's $55 a share because that's where it was in 2017. That's a huge potential benefit or tool or something. So let's be clear about 2 things. Let's restate again exactly who that applies to, who can do that, And then let's just think about what that means for a U.S. person who is also going to be paying tax in the U.S. as well as the U.K. We're not talking about rebasing in the U.S. So
Yeah, so anybody who has ever made the election to pay tax on the remittance basis and is not yet considered to be deemed domicile in the UK will have this opportunity basically to make this election if it's beneficial to them.
Okay.
Obviously, if they purchased a security in, March of 2020, or in 2023 or something like that, post that 2017 date,
May not
they
be that
can't.
helpful.
Yeah, they can't make that election. But if they've owned a security from prior to April of 2017, then they can look at the difference between that cost basis and the cost basis or market value as of the 6th of April 2017, and you choose which one is more favorable to them.
Okay.
Obviously, from a U.S. taxpayer standpoint, in the U.S., you'll still be paying capital gains tax on the full amount of
basis.
the gain, the
Yeah.
original basis. And so, if your USD gain is in excess of whatever your GBP gain ends up being as a result, then you're still going to pay an overall amount of capital gains tax in the higher of the two jurisdictions.
Right.
So for some people, that may not be all that helpful.
Maybe for a credit, but you still cash flow. Yeah. And just a small technical point. So, and maybe you don't know the answer to this, but if the 2017 price was higher than the 2020 price, and you bought it in 2020, so it was up, it collapsed when you bought it, there would be a benefit still to trying to rebase it back to 2017. But if you didn't own it, then you can't do
you don't
it, right?
have the ability
Just to be clear,
do that. Yeah,
because I can hear people say, "Oh, I could game this."
yeah. No, you would have to have owned the security back in 2017 to be able to do that.
First.
The other transitional relief as well that is going to be available for individuals is something that they're calling the temporary repatriation facility. So for anybody who has previously paid tax on the remittance basis and has untaxed income from a UK perspective over their period of residence in the UK, under current rules, if they remitted that untaxed income into the UK, they would then pay tax in the UK on whatever type of income it is. So, if they're remitting interest income, they'll pay tax at interest or income tax rates for interest. If they remitted dividends or capital gains, they'd pay tax at dividend tax rates or capital gains tax rates. With this temporary repatriation facility, it is available for 3 tax years starting from April of 2025, and it will allow people to actually remit or designate untaxed income for taxation in the UK at a reduced flat rate. And so for 25-26 and 26-27 tax years, that flat reduced rate will be 12%. And for the 27-28 tax year, that last year it's available, that tax rate will be 15%. So it will give people a 3-year opportunity to actually think about any additional clean capital needs that they may have and actually kind of clean up some mixed funds that maybe they keep offshore. And I think they're doing this as a means to essentially encourage assets to actually be able to be brought onshore from a UK perspective and be invested. But again, for people that you maybe have been looking at ways to increase the amounts of clean capital that they have available to them here in the UK, that temporary repatriation facility will likely be very, very beneficial for them to consider.
Yeah, this is quite a useful tool. I think most of us who speak to people that have been here for a while, especially in the early years when they weren't getting advice, maybe didn't know about the rules, and so they had money that was becoming mixed and therefore would have been quite difficult on a tax impact basis to bring into the UK. And so they're often scrounging for money. I don't want to buy a house. I want to do whatever. I have substantial assets in the US, but it's not tax efficient to bring it in. To have this, relatively lower tax threshold to bring some of that capital in could be really, really beneficial.
Yeah, definitely. And alongside kind of offering that, they are also kind of loosening up some of that mixed funds rules around how you remit funds to the UK. So, interestingly, with income that you end up wanting to kind of pay tax on under this TRF opportunity, you actually don't have to remit the income in order to choose to pay the tax in the UK. And then in the future, if you remit the income in a later tax year, it will actually kind of fall to the top of the ordering rules for bringing it into the UK. So you'll be able to access those kind of taxed monies under the TRF in an easier way than maybe you currently can access funds now.
That I think is really helpful as well, without going back through the ordering rules, which might be a little bit much for someone right at the second, but the ability to not have to jump through the hurdles that I think some people have had to do, of actually physically moving money across and having it touch here and deal with the tax and then move it back across to be invested more efficiently and so forth and so on. All of that rigmarole, you're saying that this program allows for a way to still make that capital accessible, but not have to move it immediately by taking advantage of this.
Yeah, exactly.
It's really helpful. That's good. One other topic relating to sort of the regime change is about assets, again, outside the U.S. that people created a trust structure around to try and keep it out of the UK inheritance tax net. We've been talking about inheritance tax. We've been talking about in and outside of the UK. So maybe that's a natural thing to also just touch on, is that they're often called excluded property trusts or topics like that, in terms of how those are being treated as part of the whole change that was announced.
Yeah. So as part of the announcements, basically, kind of the protected status around excluded property trusts is actually being removed as part of these changes. And so what that means is that, currently excluded property trusts that fall under the protected trust regime, and that is mainly trusts that are considered to be settlor interested. Settlor interested means basically somebody who is a UK resident, has settled a trust, and either themselves, their spouse, or their children can continue to benefit from that trust. So if any of those people
now or in the future,
yes, exactly. If any of those people can benefit from that trust, then that trust is considered settlor interested. And up until now, essentially, those trusts fell under the protected trust regime, which essentially meant that any income and gains that was earned inside of that trust would not be taxable in the UK until such point that a UK resident actually took a benefit from that trust. And so with the new rules that will come into place from April of 2025, essentially the income and gains inside that sort of settlor interested trust will be taxable on an arising basis here in the UK, similar to those assets actually being in their own individual name. For Americans, that aspect of the change actually isn't a huge issue, again, because having the different points of taxation from a UK and US perspective could sometimes lead to a double tax charge if it wasn't managed properly.
Right.
And so now the arising of income from both a UK and US perspective will be taxed again in the same tax year. And so it offers more opportunities for foreign tax credits to be able to be easily applied, etc. So that aspect of the change basically isn't a huge kind of blow to Americans here in the UK. But in addition to that income tax change, there is also now a change in the way that these sorts of trusts are viewed from an inheritance tax perspective.
Yes.
And that usually was the main driver for people settling excluded property trusts. The idea that essentially any assets inside the excluded property trust would be excluded property for UK inheritance tax
Clues
purposes.
in the name, yes.
Yeah. And there's a big differential between kind of UK inheritance tax thresholds versus US inheritance tax thresholds. And so it was just a very traditional planning opportunity to be able to kind of shelter at least the difference between those two thresholds from ever being exposed to inheritance tax. With these changes, excluded property trusts for inheritance tax purposes essentially goes away.
Yeah.
And so any new settlements that happen from the 30th of October 2024 would be exposed to UK inheritance tax on a personal level if the settlor retains a personal benefit from the trust. But in addition to that, could be exposed to what's called a 10-year anniversary charge at 6% under the relevant property regime. For existing trusts that were in place prior to yesterday, there are a few kind of transitional measures that have been afforded to those existing structures. But I think a lot of people probably would have wished for the government to actually take a few steps more with them. Essentially, what the government has said is that anybody who retains a reservation of benefit within an existing excluded property trust structure will not be exposed to inheritance tax on a personal level at their death, but they will be required to pay the 10-year 6% anniversary charge if they meet the long-term residency definition on the date that the 10-year anniversary actually comes up in each of those intervals. So while they aren't going to be exposed to inheritance tax on a personal basis at 40%, they will be subject to kind of this 10-year 6% charge, or for instance, an exit charge if they actually leave the UK in between that 10-year period. And so that creates a scenario where they're exposed to an additional tax that they haven't been exposed to up until now.
So that sounds pretty unavoidable, because either you leave and you get hit with the exit piece, or you're here more than 10 years and that falls into. So it feels like there's no way to sort of get out of that. You're going to be subject to something.
Yeah, the only way really to potentially get out of it is if somebody looks at their trust structure this year before April 2025 and potentially wants to kind of dissolve it under the remittance basis rules. But, I do think that there still will be a place for trusts for many people, in that, at the end of the day, it is the existing structures are still providing that personal inheritance tax protection. And we are still in a position where the UK inheritance tax thresholds are still much, much lower than the US inheritance tax threshold. So while somebody might be exposed to a 6% charge every 10 years, that is a much, much more palatable figure than having to think about the totality of those assets being exposed to UK inheritance tax. So I think, for many people, there still will be a place for the existing structures there.
Just not automatic as it sort of was before in the planning process. Yeah. Okay, so just do a quick check-in here. So we've talked really generically about capital gains tax changes. They've gone up a little bit, and we've talked about a lot of the changes to what was the non-dom regime, this new long-term residency regime. You're caught earlier, there's a longer tail, but there's some transition things that could be quite helpful, especially if you're moving to the UK. Overall, does it feel like there are more opportunities for clients to maybe do some things, or has this overall feel like this has been a net harm for more of the people that we would look after?
Yeah. I think that some of the traditional planning that, and no-brainer planning maybe that, would have been kind of the go-to previously, will now change, as a result of these changes. As I was just saying with trust planning, maybe trusts aren't kind of the way to go about estate planning anymore for many Americans here in the UK. But I think there's still plenty of planning opportunities available to everybody, to be thinking about. For example, if from an estate planning standpoint, if people aren't thinking about excluded property trusts, they can actually, from a US UK perspective, still think about things like family limited partnerships. If there's a reason that they want to have a structure where they're retaining some level of control over those assets and they aren't prepared to actually give an outright gift, then there are still going to be ways for people to think about managing exposure to UK inheritance tax versus the US. And so, again, it's not that there aren't opportunities for people to take advantage of. It's just going to kind of change slightly. I think probably the use of insurance as well is going to probably increase to help provide some of that protection as well.
I was just speaking to one of those insurance providers at an event last night as the budget was coming out. They were saying, yes, this could be good for us. So I think that's being reflected in other comments. So a bit of a pause. We've talked a little bit about capital gains. We've talked about the changes to what used to be called the non-dom regime. But it would be remiss in our conversation, while we have access to your expert knowledge, to not also recognize where we are in the calendar year and just do a little bit of a reminder for our clients and wider audience about the year end and some of the thoughts around what people should be doing in general, and if any of that has changed given everything else we've been talking about.
I think one of the biggest things to think about from a year-end perspective is actually thinking about whether or not any tax payments need to be made before the end of the year. Because the US tax year is on a calendar year basis and the UK tax year is on that April 6th to April 5th basis, the ability to actually align tax credits from a US and UK perspective is really, really important. And many people did engage in some level of accelerated income planning in the 2024 kind of tax year because of the potential changes associated with the budget announcements. And so where maybe people have accelerated income recognition from a gain standpoint, or maybe had some other sort of transaction that has taken place, I think it will be important for them to review whether or not any prepayments to HMRC need to actually happen before the 31st of December in order to make sure that foreign tax credits can be claimed on the 2024 US tax return. So I think that's probably one of the biggest things that people should be thinking about, looking at year-to-date income and any estimated income that will be had between now and the end of the year in the form of maybe capital gain distributions or other sorts of dividend payments, and kind of incorporate all of that into the planning to see whether or not they have any tax payments that should be made.
That's a really important one. I mean, there are a number of things that advisors always talk about in terms of sort of doing your basic allocation of cash for pension contributions or for charitable contributions or what have you. Nothing I think we've been talking about would seem to suggest those things have changed, but it's also just maybe worth reminding some of the other typical year-end things people should be thinking about.
Yeah, absolutely. I think all of the normal kind of year-end planning things are relevant to be thinking about this year. If people want to give any charitable donations or other types of gifting, as a reminder, just from a gifting standpoint, in the UK, when you give away assets, they will usually fall under what's called the potentially exempt transfer rules, or sometimes they can fall under gifts out of income. And so, if you're giving a lifetime gift, provided you survive that gift by 7 years, then it falls completely outside of UK inheritance tax net. On the US side, you have an annual gifting allowance of $18,000 per individual for 2024. So to the extent that individuals are looking to utilize their annual gifting allowance this year, absolutely makes sense to do that before the end of December. Equally, again, with charitable donations, anything that they want to make, those gifts have to be made by the end of December. For anybody with pensions that have required minimum distributions that have to take place, those also have to be processed before the 31st of December. With respect to pension contributions, you do more often than not have the ability to make pension contributions in the US in relation to 2024 up until the 15th of April of 2025. But in certain instances, contributions do need to be made in the calendar year. And it's usually worth kind of wrapping all of that up at the same time. So those are all, very traditional kind of planning opportunities. I think with respect to kind of capital gains and that, there isn't a capital gains tax allowance from a U.S. perspective, but there is always the exercise of looking at harvesting tax losses from a U.S. perspective. So looking at your portfolios and whether or not you can actually realize any losses to offset gains that have been realized. I think Americans that are here in the UK have a little bit harder job in kind of doing that traditional type of planning, just because any transactions that you have to that you make, you have to consider GBP gains in addition to the USD gain position. So sometimes there isn't as much individuals can do in that regard, but it's still always very, very worth kind of reviewing an investment portfolio in that lens to see if there are any opportunities to take advantage of before the end of the calendar year.
I'm very glad you mentioned that, because that misalignment between what your gain position is in dollars for U.S. taxes and what your gain position may or may not be in sterling for UK, given the time frame of the holding and the change in the FX rate, that difference can really trip people up. And what seemed like really good planning can actually have some adverse consequences without factoring those both in. So I'm really glad you highlighted that. Of course, the other thing that people can do in making contributions, charitable contributions, is gifting appreciated assets. And that maybe is particularly relevant given a higher capital gains rate.
Yeah, absolutely. I think, in the choice of making charitable gifts, you can either gift cash or appreciated assets. And if you have an asset that has a particularly large unrealized gain inside of it, that is even more attractive to actually kind of look at gifting that sort of asset now, in light of the fact that capital gains tax rates have gone up. So it's always worth kind of, when you're looking at making those sorts of gifts, looking at kind of total assets available and kind of where it's most efficient to actually make that gift from.
Perfect. You mentioned the potentially exempt transfer or PET rules in the UK. And that was, I guess, one of the surprises for some of us that didn't get changed. There was so much noise about changing things that the ability to gift effectively unlimited amounts in a UK regime basis, as long as you survive the gift by 7 years. Were you equally surprised that remains as powerful as it does?
A bit. I think, when there were kind of murmurs around inheritance tax changes, there were two areas from an inheritance tax standpoint that, I kind of viewed as the biggest low-hanging fruit that kind of exists there. One is the potentially exempt transfer kind of lifetime giving rules, because so few people actually pay inheritance tax because they actually give away their wealth during their lifetime. So there were murmurings around kind of the number of years that pets would apply for, maybe
Shrinking
would be extended to 10 years instead of 7 years.
To catch them further.
Yeah,
right.
Or putting some sort of lifetime limit around how much you could give away before any gift tax might be kind of assessed.
Right.
But yeah, they didn't go in that direction. But one direction that they did go in regard to inheritance tax, which I also thought was kind of the biggest low-hanging fruit, was around the inheritance tax protection of UK pensions.
Yes.
And basically the announcement was that UK pensions would be exposed to inheritance tax from April of 2027. And so, that pension pot that, kind of exists right now as kind of a form of excluded property, but being a UK asset will no longer be considered excluded property from kind of that UK inheritance tax net after April of 2027.
I know from a UK perspective, that's quite a big change. I mean, I was speaking to some people who are just Brits who've been here forever, and they were sort of aghast at the notion that this is now in the UK inheritance tax regime. But from a U.S. perspective, that's not that dramatic. So U.S. pensions were already in the U.S. inheritance tax regime. It's just a really much bigger catchment area.
Right.
For a U.S. person thinking about U.S., U.K., and so forth, does this change anything in terms of how we think about pensions?
I think in some respects it does, from the standpoint that, again, because we're dealing with such a large differential between the UK and the US, that pension asset, even though that pension asset might have been exposed to US inheritance tax at the much larger threshold, now actually is part of that differential equation between the UK and the US. And so it does kind of change the dynamic a little bit in terms of the assets that are exposed to UK inheritance tax versus the assets that are exposed to US inheritance tax. But in principle, on an overall basis, it doesn't necessarily change very much. I mean, I think what will just happen as a result is that people can no longer look at the UK pension pot as kind of a legacy kind of tool, purely as a legacy tool. And if they want to give away those assets, they'll have to look and think about a drawdown strategy, and then subsequently basically gift on those assets outside of the pension wrapper, which is probably exactly what the government was thinking in making that change, is that, they will generate more income tax revenue off of pension distributions if people ultimately want to try to prevent the pension pot from being exposed to inheritance tax down the road.
Yeah, I guess trying to get those assets more productively redeployed or just taxed.
Yeah.
So I think we've covered a lot of ground. This is probably a lot for people to digest. Inevitably, they will be calling in to speak to us, to talk to wealth advisors and wealth managers, and talk to yourself for more complicated cases to really delve into this in more depth. There's some really, specialist areas that probably apply to only a handful of people, whether it's about business property or about agricultural property or some of the corporate stuff and so forth, which probably doesn't make sense to try and get into, but people are welcome to come and talk to us about it individually. But is there anything else that we haven't touched on, or any sort of final closing thoughts you'd like to share with our clients and others about the overall budget and changes and year-end timeframe?
I mean, I don't think that there's necessarily kind of aspects that we didn't touch on that make sense to dive into right now. But I think kind of the key message is, again, we have more clarity about how things are going to change from both today and from April of 2025, and also from future tax years as well. And so it absolutely just makes sense to have a conversation with your wealth manager to really kind of think about how these changes do actually kind of impact yourself and your situation. And it could be for some people that it really doesn't impact anything and there's no actual action that really needs to be taken. But I think for many people, there may be some opportunities to either tweak something or restructure something to be able to either benefit from some of the transitional reliefs or kind of set themselves up for more efficient taxation on a go-forward basis. So, I think I would definitely encourage people to reach out and have those conversations. And if nothing else, it will give them the peace of mind that there isn't anything that really needs to happen.
Perfect. That's really helpful. Well, given that in the January timeframe, there'll be a new U.S. government in place, and they'll start making their new policy pronouncements. We may need to have you back in the first quarter to start to digest those. But for now, thank you so much for sharing your wisdom and insights, given what's happened here in the UK and how that applies to our clients and others. And hopefully, we'll be back soon with more information to share.
Thank you.